Podium, CGTN, Toronto, Canada.
For more about this and the markets as we kick it off this week, Thomas Hayes joins us. He's the founder and chairman managing member of Great Hill Capital. Good to see you again, sir. What happened over the long weekend? Have we forgotten the doom and gloom of last week?
Well, I'll tell you, Phil, we saw Bullard come out and say, perhaps we don't have to say in quantitative tightening as long as people expect. That was a positive thing. But the fears, there was positive and there was a lot of negative. There was a huge amount of pessimism about an earnings recession, which so far is simply not manifesting. Every single week, estimates have been going up. For 2023, the estimates on the S&P 500 for earnings are $251.76. What that means in English is that we're trading at about 14.7 times next year's earnings, and that compares to the 5-year average of 18.6 times, which included the last tightening cycle, Phil.
But hang on, isn't the whole point of what the Fed is trying to do is to slow the economy down so that we reduce inflation and have a lower GDP in essence and reducing demand? And wouldn't that naturally reduce earnings? So if it's true that investors think that earnings are going to be great again, then what the Fed is doing isn't really working. It's going to have to do more of it. I mean, they're just going to have to keep raising rates.
Well, you have in real terms and in nominal terms. Keep in mind, inflation is 8% this year. So to see earnings growing at this clip is not unusual. But certainly the actions that the Fed has taken are having an impact. Consumer confidence is the lowest in history, as we saw. Sentiment is the lowest in history. We're dramatically oversold. And what we're seeing, first off, we did have a negative GDP in Q1. And if you look at the Atlanta GDP now, it's at 0. We're going to get a new print, I think, this week. And if that goes negative, hypothetically, we'd have 2 consecutive quarters of negative growth, which is the technical definition of a recession. That's the bad news. The good news is how much of that is already priced in, Phil, with the S&P down in a bear market more than 20%, the NASDAQ got down more than 30%. With the employment situation, quite a bit of that recession may already be priced in.
I have a feeling that you were in there buying somehow this morning and you've already pushed the stocks up. 2 companies I do want to get to. Meta. This is controversial because we all know about them targeting ads to people. And this is a DOJ investigation that claimed that they targeted users with housing ads based on algorithms, basically violating the Fair Housing Act. And I suspect that Facebook probably isn't the only person that's violated all this. What does this settlement potentially mean to tech companies?
Yeah, well, first of all, it's terrible that they did that. But if you step back dispassionately, they'll pay the fine, they'll deal with the regulations that they've got to deal with. The stock is down now about 60% off of its recent highs. It's trading at about 13 times next year's earnings, growing earnings at 15 to 20% over the long term. The key is, when you think about it from a business perspective, Phil, Mark Zuckerberg always figures it out. This stock is exceptionally low, and if you look out a few years from now, this may be a bargain, and we've been nibbling at these levels.
Okay, you actually were buying. Tesla, they're cutting back salaried workers by 10%, and I think I take it with a grain of salt when I read Elon Musk's tweets these days, but meaningful to you in an industry that supposedly is growing like gangbusters? Why the layoffs at all, and why the cutbacks?
Well, I think it's 2 things. I think a lot of companies, actually, this is pretty widespread. During COVID, when they had a large amount of middle managers at home running the business remotely, I think the companies realized that there may be more efficient ways to do it, and not all of the middle managers were producing at the level that maybe they thought they had been. And in anticipation, with all of the kind of fear in the market of a potential slowdown in the next year, year and a half, I think companies are trying to get ahead of the curve and seeing where have they been less productive and where could they be more productive. The key with Tesla is the demand has been phenomenal, so he needs more people on the assembly lines. But as far as more managers, maybe he's going to pare back just a bit.
By the way, there was an article that they're building apparently human robots. Very quickly, give me one sector you want to buy and why.
I want to buy China tech. It bottomed in March. Alibaba's up 44 some odd percent off of the lows. The rest of the world is tightening policy. Europe and the United States, there's one large economy that's easing policy coming out of the COVID and the lockdowns. That's China. That's where you want to be in the intermediate term. I think that you're going to see continued growth, and we like the bellwethers, the Alibabas, the Tencents, et cetera, at these levels. If you look 3, 4, 5 years out, the earnings power, the growth, both in China and in Southeast Asia, can be phenomenal.
All right, Thomas Hayes, a bull on China technology. Hector, let's get him back, and we're going to drill down on this a little bit more. Always good to have you, Thomas Hayes from Great Hill Capital.